Imagine this. Same $50,000. One path buys a rental and looks rich fast. Then hidden costs show up. Repairs, vacancy, taxes, time. Suddenly, the deal that looked better starts looking heavier. One investor works for every dollar that comes in. Debt, stress, and late-night problems come with the house. The other stays patient, keeps buying, and lets compounding scale quietly. So which one actually makes more money over 20 years?
Let me show you why this is so tricky. Real estate can grow faster because of leverage. Stocks can grow easier because of compounding. But if you ignore stress, debt, and time, you'll get the right-looking answer for the wrong reason. You've probably heard both sides. One person says real estate made all the millionaires. Another says index funds beat almost everyone. Both sound confident, both can show you examples. And that's exactly why this confuses so many smart people. Real estate feels powerful because you can see it. There's a house, a tenant, rent coming in, keys in your hand. But visible wealth is not the same as usable profit. A lot of the real story is hiding behind the wall. Stocks feel boring because the progress is quiet. No keys, no tenants, no dramatic before and after story, just numbers slowly climbing on a screen. And because it feels boring, people often underestimate how powerful that simplicity becomes over time. At first glance, this debate is really about one question. Do you want the investment that looks richer sooner, or the one that quietly builds wealth in the background? Those are not always the same thing. This is where it gets interesting. If you only compare returns, you miss half the picture. To make this fair, we need to compare money, time, stress, and flexibility. Miss one of those, and your conclusion starts leaning fake. So let's set this up properly. Same starting cash, same income, same timeline, same discipline, same goal. Build long-term wealth. Once the rules are fair, the comparison gets much more honest and much more useful. Here's the hidden trap with rentals. People count the rent check, but forget the interruptions. Repairs, vacancies, paperwork, tenant drama, random emergencies. The property might be passive on social media, but in real life, it often behaves like a part-time job.
And stocks have their own trap. They're easy to buy, but emotionally hard to hold. When the market drops fast, people don't feel calm and rational. They feel fear, and behavior can ruin a mathematically great investment. Let's build the baseline. Oliver has $50,000 saved, earns $55,000 a year, and wants to grow wealth over 20 years. Nothing flashy here. The power comes from what each choice does after the starting line. On the real estate side, that $50,000 becomes a 20% down payment on a $250,000 rental. That means one thing immediately. Oliver is not buying $50,000 of assets. He's controlling much more. On the stock side, that same $50,000 goes into a total market index fund, plus automatic monthly investing. No debt, no tenants, no property. Just ownership in thousands of businesses and a system that keeps feeding the account every month. That gives us the real battle. Real estate's superpower is leverage. Stock's superpower is compounding. One lets you control more today. The other grows more smoothly over time. Which one wins depends on what happens after those strengths meet reality. Here's what most people don't realize about a mortgage payment. Not all of it builds wealth. Some goes to interest, some goes to taxes and insurance. Only part of it increases equity. That matters because the headline payment can sound more productive than it is. Rent is the number everyone loves to quote, but gross rent is not profit. Once you subtract vacancy, taxes, insurance, maintenance, and surprise repairs, the number you actually keep can shrink a lot faster than most new investors expect. Stocks work differently. The first years often feel almost disappointing, but then returns start earning returns and contributions start stacking on top. That's the magic of compounding. It feels weak early, then suddenly becomes hard to stop. This is where real estate starts looking brilliant. If the property value rises while the mortgage balance falls, equity grows from both directions. That can make one house create wealth much faster than your original cash would suggest. But here's the catch. Houses are not spreadsheets. Roofs age, water heaters fail, pipes burst on weekends, and these costs don't arrive in neat monthly installments. They hit in lumps, which can distort your returns and your stress level at the same time. Let me show you a cost almost never included: your time. Every call, every showing, every repair decision, every late-night message has a value. If the property pays you $400 but eats 20 hours, the math looks very different. Now, think about liquidity. If you need money fast, stocks are usually easier. You can sell with a few taps. Real estate is slower.
Selling takes time, paperwork, and friction. That slower access can be either discipline or a serious inconvenience. There's also concentration risk. One property means one location, one neighborhood, one tenant stream, one local market. An index fund spreads you across thousands of businesses. That doesn't remove risk, it changes the kind of risk you're carrying. Stocks come with volatility instead of leaky roofs. Prices can drop hard, fast, and publicly. The investor's job is not fixing anything, it's staying put. That sounds easy until your screen is red and your brain starts telling you to run. Taxes matter too. Real estate can offer powerful deductions and depreciation. Stocks are simpler, but usually less flexible in that area outside retirement accounts. So if you ignore taxes entirely, you're not comparing the real version of either strategy. So already you can see the pattern. Real estate scores high on leverage and tangible control. Stocks score high on simplicity and scalability. Neither wins every category, and that's exactly why this debate gets oversimplified so often. Now, let's move from theory to lived experience, because the spreadsheet only tells half the truth. The other half shows up in the years between your first decision and your final result. Meet Maya. She uses her savings for a rental property because she wants visible cash flow, real ownership, and long-term equity. On day one, she feels smart, decisive, and financially ahead of people doing something quieter. And honestly, that early feeling is powerful. She sees rent coming in, she sees a house under her control, and every payment feels like proof she made an adult, serious wealth-building move. At first, the napkin math looks great. Rent comes in, mortgage goes out, and there's money left over. That's the exact moment most people mentally declare victory. But the napkin is about to get crowded.
Property tax, insurance, maintenance, vacancy, leasing costs, maybe management. Once those enter the picture, the gap between gross rent and real profit starts getting very small very fast. Then the time cost begins. Tenant questions, repair decisions, scheduling, messages at inconvenient hours. None of that shows up in the rent number, but it absolutely shows up in Maya's life. Now add one empty month between tenants. Suddenly, there's still a mortgage, still taxes, still bills, but no rent. This single gap can wipe out a surprising amount of what looked like easy profit. And then something breaks. Maybe it's the water heater, maybe it's plumbing, maybe it's the roof later. The important part is this: the investment keeps asking for cash even while it's supposed to be paying you. This is where the emotional trade-off appears. Her wealth may still be growing through equity, but her experience feels heavier than the original sales pitch. The return is real. The effort is also real. But here's why real estate keeps winning believers. If the local market rises, Maya benefits on the full property value, not just the cash she put in. That's leverage doing exactly what people love about it. Each year, some debt disappears and some equity appears. That feels slow in month one, but meaningful over many years. It's one reason real estate can look mediocre in cash flow and still create solid net worth. And there may be tax advantages too. Depreciation can make the property look less profitable on paper than it feels in reality, which can reduce taxes. That's not magic, but it is a meaningful edge when used correctly. Now for the scenario nobody includes in the optimistic version: a bad tenant. A few unpaid months, legal friction, damage, cleanup, and suddenly an entire year of expected profit can disappear into one ugly episode. This is the turning point. The investors who do well usually stop treating the property like easy passive income and start treating it like a business with systems, reserves, and better decision-making.
10 years later, Maya may be glad she stuck with it. The property is likely worth more, the loan is lower, and her equity is much bigger. But she didn't just hold an asset. She managed a moving, costly system. So story one is not real estate is bad, it's this: real estate can build serious wealth, but only if you're honest about the workload, the risks, and the uneven way the returns actually arrive. Now let's isolate the variables that actually swing the result, because most arguments online compare the loudest features, not the most important ones, and the most important ones are often hiding in the details. First variable, leverage. This is the most powerful reason real estate can outperform. A relatively small down payment controls a much larger asset. If values rise in your favor, the return on your actual cash can look incredible. But leverage cuts both ways. If property values stall or unexpected costs pile up, the debt does not become gentle just because the market did. Leverage magnifies good outcomes and painful ones. Second variable, rent-to-price ratio. Some markets look great in theory, but produce weak cash flow in practice because prices are too high relative to rent. In those places, the property often depends heavily on appreciation to save the deal. Third variable, contributions. Stocks scale beautifully when you keep adding money. You don't need another mortgage or another property inspection. You just increase the monthly investment and let time multiply the extra effort. That's a huge difference in scalability. To invest more in stocks, you often just contribute more. To expand in real estate, you usually take on another property, another system, another debt relationship, and another layer of complexity. Now, here's the part most spreadsheets miss: temperament. Some people feel better owning a tangible asset they can influence. Others thrive with systems they don't have to touch. The best strategy is not just profitable, it's sustainable for your personality. Real estate often gives you more control. Stocks often give you more freedom. Neither is automatically better. But if your investment style constantly fights your natural wiring, even a smart strategy can become hard to stick with.
Behavior risk matters more in stocks than many people admit. The market can be mathematically generous and emotionally brutal. If you panic and sell at the worst time, the strategy did not fail. Your behavior did. Preparation changes the real estate experience dramatically. Investors with reserves, systems, and realistic assumptions handle shocks better. Investors who under-budget often discover too late that their profit was only there because they forgot future costs. Liquidity sounds boring until life gets messy. Job loss, health issue, family need, opportunity, relocation. The easier your money is to access, the more options you keep. That flexibility has real value, even if it never shows up on a highlight reel. Tax treatment can swing the decision too. Skilled real estate investors can use deductions and depreciation strategically. Stock investors often lean on retirement accounts and long holding periods. Different tools, different advantages, and different kinds of discipline. And no comparison is complete without context. Interest rates, local rents, valuations, market sentiment, and personal borrowing costs can all shift the result. That's why a good answer today can become a weaker answer in a different environment. So by now, the picture is clearer. This is not a battle between a smart asset and a dumb one. It's a battle between two very different engines for building wealth. Now meet Noah. He chooses index funds. No property search, no loan officer, no tenants, just a diversified fund, automatic contributions, and a plan to leave it alone long enough for compounding to matter. At first, Noah's choice feels less impressive. There's no dramatic story to tell, no visible asset to point at. Socially, it looks quieter, but quiet strategies have a strange habit of becoming very loud years later. The early years don't feel magical. The account grows, but not in a way that creates excitement. That's exactly why so many people stop too soon. The strategy asks for patience before it offers visible payoff. Then the shape changes. This is where it gets interesting. The account is no longer growing mainly because Noah adds money. It's growing because the money already inside starts doing more of the work.
But then the emotional test arrives. The market falls hard. The account drops. Suddenly, the strategy that felt easy becomes psychologically expensive. And this is the moment that separates investors who stay rich from investors who stay anxious. Here's what most people don't realize. The real work in index investing is not choosing the fund. It's refusing to sabotage the fund when fear gets loud. That sounds simple. It rarely feels simple in the moment. Noah keeps investing anyway. That's not dramatic, but it's powerful. Buying through bad periods means new contributions purchase more shares, and future recovery has more weight behind it when the market eventually turns. And then recovery does what recovery usually does. It happens before the average person emotionally feels ready. And this is the surprise. After enough time, Noah's quiet portfolio can end up surprisingly close to the property path, sometimes even ahead, depending on contributions, behavior, and market conditions. Boring does not mean weak. It often means scalable. So story 2 is not stocks are effortless. It's this: index investing is operationally simple, emotionally demanding, and incredibly powerful for people who can automate, stay patient, and keep buying when everyone else feels nervous. So let's make this practical. Not for a headline, not for a debate, for your actual life. Because the best investment is the one whose math works and whose process you can realistically stick with for years. Real estate usually fits better if you like hands-on control, understand your local market, have healthy reserves, and can handle debt without losing sleep. It helps even more if you're willing to treat the property like a real business. Stocks usually fit better if you value simplicity, want liquidity, prefer automation, and can stay invested during scary markets. The less you need constant control, the more powerful a disciplined index strategy tends to become. Here's the better way to think about it. Don't ask which asset is more exciting. Ask which discomfort you can handle better. Leverage and property stress, or volatility and emotional patience. That one answer narrows the decision fast. Let me show you a simple framework. Compare both options across 4 categories: cash flow, long-term net worth, freedom, and time demand. Most bad decisions happen because people only compare the first one and ignore the other 3.
And please do not borrow someone else's numbers. Your mortgage rate, local rent, repair reality, tax situation, and risk tolerance are different. A strategy that looks brilliant on another person's spreadsheet can underperform badly in your life. This is where smart people protect themselves. Never go all in without margin for mistakes. Real estate needs reserves. Stock investing needs emotional runway. In both cases, survival is what gives compounding enough time to work. And yes, many people eventually do both. A property for leverage and income potential, plus index funds for diversification and automation. For the right person, the smartest answer is not either or, it's sequence and balance. If you remember one thing, make it this. Wealth usually comes from a repeatable system, not a dramatic one-time choice. The best plan is the one you can keep funding, keep holding, and keep improving for a very long time. So which one makes you more money? The honest answer is less dramatic than the internet wants. Both can work, both can fail, and the difference often comes down to behavior, assumptions, and the hidden costs you are willing to count.
That's the real formula. Math tells you what could happen. Temperament tells you what you can stick with. Time is what turns both into actual wealth. Ignore any one of those, and your strategy becomes a lot weaker. So don't choose based on a headline, a clip, or somebody's confident opinion. Choose after you run the full numbers, stress test the ugly scenarios, and decide what kind of investor you actually want to be. And now I'm curious, after seeing the real trade-offs, which path fits you better right now? Property, index funds, or some mix of both? The right answer says a lot about your goals, not just your portfolio. If this helped you see the debate more clearly, hit subscribe, leave a like, and tell me which side you lean toward. Those comments are always interesting because people value completely different things in wealth building. And if you want the next piece of the puzzle, I'm working on a video about whether you should invest first or pay off debt first, because that choice can change everything before you even buy your first asset. Thanks for spending this time with me. I know this topic gets emotional fast, but when you slow it down and count everything, the answer becomes much more useful and a lot less noisy. Take care, keep learning, and keep building with intention. I'll see you in the next video.